a quick video that's going to go over equity, specifically module 3.9. I'm going to talk through this exercise here. I just want to put it in perspective in terms of all your assessment for this unit. All these words are very confusing, very big words and very in-depth. Even as a fully qualified accountant, you may not know the definition of every single one. So in all your practical stuff, it's going to be a lot more high level than what you probably see here. This is very intense theory. So I just want to firstly make sure that you understand that that when you come into the really practical assessment, which is the main portion of this unit, it's not going to go in this very specific detail. So I guess they're hitting you with the theory really hard, so when it comes to the practical stuff, hopefully it already sinks in. So this is all going over your balance sheet. So week 3, I think if we have a quick look, let's look at our modules over here. Week 3 is our balance sheet. So our balance sheet is made up of assets and liabilities and equity. And do we remember the accounting equation? It is assets here equals liabilities plus equity, but this video is just going to quickly go over this equity section. Now, equity is basically the amount that a shareholder or whoever's invested in a company could run away with at the end of the day. So I find Investopedia really helpful, despite it's not a resource that you should ever quote within any assessment because anyone can adjust it. It is a wonderful resource to learn off because they simplify it so easy, and for me it helps me understand sometimes. And sometimes the textbook is wonderful. Sorry about all my friends' text messages. Whilst the textbook is wonderful, sometimes it's good just to have that really little snapshot of information. So here is your equity definition here. Basically what it's saying is if we were to liquidate the company, and what that means is sell everything up, what would the shareholders, so the owners of that company, walk away with at the end of the day? So that is our assets portion minus our liabilities will equal our equity. So that's just mixing around that accounting equation of assets equals liability plus equity. So equity really should be our net assets. So hopefully if the company's going well, assets should outweigh liabilities. So again, as this says around here, basically if we were to sell everything off today, what would the company be worth? Now, you have multiple parts within equity. Within this unit, you'll see 2 major ones. One is called capital and one is called retained earnings. So capital portion is usually however much so if you're looking at a very small company, you've got a director and they're setting up a business and they want to inject $50,000 of their personal funds to get this business up and going, that's called capital. So they're injecting money into the business, so that's the capital they have in the business. So that's $50,000. Then say a year later, they want to pull out $20,000 out of the business, and that is called owner's drawings, or other word is drawings. So they're wanting to take out that money out of the business, and because they're the director, that would be then a reduction in the capital by that $20,000 of drawings. So then your net position of the capital will be the injected amount of $50,000 minus your drawings of $20,000. So your net capital is then $30,000. So capital is really looking at how much the owners have injected and taken out into the business. So what's their stake in the business? Okay, then another portion is our retained earnings that you'll see in the balance sheet. So our retained earnings, if you've already gone through week 2 in the worksheet, you'll notice that the retained earnings is, if we jump over here, this is our modules, you'll come to it in week 4, is basically our profit and loss. So retained earnings is looking at what are your revenue? What are your expenses? Are we up or are we down? And if we're up, we're making more money than expenses. We've got profit. That means we're rolling that profit into the next year. So that's in our retained earnings there. So if we have a profit, our retained earnings is going to be a positive. If we've got a loss, it's going to be a negative. So our retained earnings is basically bringing over that profit or the loss into it, and that is basically, hopefully, if it's a profit, it's building up that equity portion in a business. So in this unit, they're the two major items for equity you'll see. If we jump down here, remember I said there's a lot more words here than we actually are going to use in these practical exercises within this unit, but it is important that you kind of understand it all. So we've got these three here. We've got share capital. So share capital is exactly the same as capital. It's basically when you've got shareholders involved. Reserves. So reserve is when you have a kiddie pool of money. You're putting money aside for something in the future, like contingencies. So it's just in your balance sheet. It's an amount we're booking aside for something that may occur. But don't get too wound up about that. You can always look at, I've got here an Investopedia portion here, which is basically saying it's used for contingencies or capital offset capital losses. Not going to go into too much detail because the unit really doesn't go into that much detail about capital reserves. We're keeping this super high level, but that is another portion of equity. But you won't find that in your practical side of things. Minority interests, so that's basically capital, but it's when you are not the main owner. So when we have a business, you have a percentage of ownership. So if you have a business and it's just one director, you own it 100% and capital is all yours. But if you're looking at a massive company where you might have, say, 55% is owned by two directors, and whilst the other 45% is owned by multiple shareholders, then the minority interests is the 45%. So 50-50 is where they both have equal decision power, but when someone has more than 50%, they're the majority, and under 50%, so 49% or under, is the minority. Okay, so that's basically just capital. We put it all there. Retained earnings we've already discussed. So that is basically our profit and loss that we're pulling over into our balance sheet. We're recognizing either the profit or loss portion in that equity section. So quick recap, our balance sheet has the three accounts, which is our assets, and that's to the left-hand side. And then we have our liabilities and our equity. So we know that assets equals liability plus equity. If we want to isolate and figure out what is our equity portion, it is net to assets. It's our assets minus our liabilities. So you can interchange that formula to do your calculations to figure out what amount is in each category. Again, at the end of the day, our equity is, if we're a shareholder of the business and we needed to get rid of everything, we needed to close up shop, walk away, what's the value of our company? So as I mentioned earlier, hopefully our assets outweigh our liabilities. Otherwise, we've got some serious issues. I have had a question about the valuation of a company. And that is a little bit different than what I'm saying in equity about the value. So you can value a company in order to sell it, and you get a third party to do that. But that's completely different. We're looking at, in terms of equity, if I were to walk away from the company right now, what would be the value of my, what's the amount I'm walking away with? And then up here, so this question here is just looking at our differences between liabilities and an equity here. You've got here payable, so we've visited that already. It's our accounts payable. Then we've got interest-bearing liabilities. That is a fancy word for debt. So if we get a loan on a piece of property, we are paying interest on that loan. Deferred tax liabilities, that's basically tax being paid in the future, and then provisions. So that's when we know we have a tax bill or any other kind of bill and we're funneling money away for it to pay in the future. We're basically reserving funds. So they're our liabilities. So here we go. This is the question. Not going to go into too much detail, but super simple. Half of these are given it to you in the wording of the item. So say that's provision. Equity settled benefits reserve. Again, that's a reserve. Lease provision is a provision. Revenue received in advance, so that is deferred revenue. Ordinary shares, that is our capital. Hedging reserve, again, that's a reserve, that's our equity. Unsecured bank loan, that is borrowings in our liability, so we'd probably call that a non-current liability. And then lease accrual. You will learn more about accruals, but accruals is something where you're recognizing an expense now, but it's not yet paid. So, for example, if we are paying our electricity or our rates or any other kind of bill, and it is, just trying to think how we word it. If it's incurred in the past, so say we've just gone through the last 3 months and as at today, we've already incurred that expense because we've used that electricity for the past 3 months, but we have not yet paid it. So we know we've got an expense to pay in the future. So that's an accrual. And provisions you will see, so that's where we're setting money aside for an expense in the future. We have not yet incurred it. So there's a bit of a timeline difference there. So accruals are where we haven't incurred a debt, an expense, and we have not yet paid for it. A provision is when we know we've got something in the future, but we're not quite sure on it exactly that we're going to have to pay. So that's really usually our tax bills, and we might put money aside for that. So they're both liabilities, but it is important for this subject to know the difference between accrual and provisions. We will be going over this, but yes, that is a liability. Sorry about if you can hear anything in the background. My partner's friends over in there on their guitars. But that is basically the summary of it. Super simple in this unit. We're not trying to overcomplicate getting into the minutiae of it. We're just really trying to broaden your financial knowledge for everyday life and for business life. So again, equity, our main two things is our capital and our retained earnings that you'll be seeing in this. And the main two difference is our capital. So it's your owners of that company. What are they injecting? What are they taking away? So what's their net position in that company? And then our retained earnings is then looking at our profit and loss, and we're funneling in that profit or loss that has incurred during that year. And then that should equal, so that's our total equity if we add those two together. And then hopefully if everything reconciles, that should equal our assets less liabilities. Or we can say our liabilities plus our equity will equal total assets. So any other questions, feel free to post below, but hopefully that sums it up. As I said, Investopedia is a wonderful resource for learning. Never reference it in assessment. Obviously, always head back to your e-text first, and then if that doesn't quite click, then I do highly recommend using Google and also YouTube to see what else can click for you.